My name is Seth Foreman, CEO at Social Suite, and I'll be your host for today's webinar. Now imagine a world where your organization's impact on the environment and society is not just a check-in-the-box exercise, but a driving force for your business decisions. This is the world of double materiality. Today, our experts will dive into the heart of this transformative approach, leveraging both GRI and IFRS standards, insights into conducting robust materiality assessments, and real-world examples to align your reporting with global frameworks. Whether you're looking to drive transparency, strengthen your ESG strategies, or deliver long-term value for your stakeholders, this webinar is your opportunity to transform compliance into competitive advantage. Now, for those unfamiliar with Social Suite, we're a global sustainability and impact technology company specializing in double materiality software and services. All the way back since 2015, we focus on helping hundreds of organizations with simple, cost-effective, and powerful solutions, welcoming the likes of DirecTV, DoubleVerify, Cooper Companies, and many, many others to comply with global sustainability regulations and creating value. Now, don't forget that Social Suite has produced a variety of informative and thought leadership content on a whole slew of different sustainability topics. Make sure to check out our webinar section of the Social Suite website, or you could go onto the Social Suite YouTube channel to learn more. And now I do want to go through a couple of housekeeping items before we begin. The content of today's webinar will last approximately 30 to 45 minutes or so, and then we'll hold the Q&A session. If you do have any questions or comments, feel free to add them into the chat box on the right. Our hosts and experts today may answer them in real time, or we'll get to it during the Q&A session. We are going to record today's webinar, and we will be distributing the webinar recording at the conclusion of the webinar. We're also going to have polling questions in the webinar. So if you go to the top right and you see the little polling button, you can actually, if you don't mind, responding to those polling questions, and we'll get to it throughout the webinar as well. So you can see it right at the top there. Now let's meet our experts today. Today we have Dr. Tim Siegebeek van Hukelam. He's currently the Chief Impact Officer at Social Suite. Tim has over 15 years of experience in different sustainability roles, and at Social Suite, he helps us lead full policy leadership to help us with developing our products and also engaging with our different customers. Now, we're also here and excited to have Matthew Rusk on today. He's the head and currently the head of GRI North America. Matt has over 10 years experience in a variety of corporate sustainability roles across a whole variety of different industries. And finally, anchoring today's session, we have Jeffrey Crawford, who's the managing director of Azuri. Jeff has over 20 years experience, most recently at Blackstone, operating in a head of sustainability role at a number of different portfolio companies. He has experience at the United Nations and many other advisories as well. He also was the member of the advisor group on SASB. So really excited to have our group of experts today. Now I'm going to leave the room and I'll be coming back on for the Q&A session. Tim, I'll pass the baton over to you to take over. Thank you.
Excellent. Thanks, Seth, and it's a pleasure to have you here today, Matt and Jeff. Thanks for joining us. We're going to talk about double materiality today, which is always an exciting topic. A lot of people are really kind of, excited to learn more about that. So with that in mind, I want to run on the chat on the right-hand side a quick poll there, and just get a sense of why people are interested in double materiality. So I'll share that now, and while we kind of go through the agenda for today, if you can fill that out, that's quite useful for us to know, because we do see that there's the compliance. So in Europe, we have CSRD. That might be the reason you're looking at double materiality. It might be a demand from your investors. It might be that you're using it to update your sustainability strategy or determine your reporting requirements, or it might be a mix of all of those things. So It's always really interesting for us to see where people are coming from. So we see that indeed a lot of people are saying it's a mix of a variety of those requirements there, which is not surprising. We do have a few people that tick CSRD as well. So that's a really good place to start. Now, we do know that in Europe, in the EU, with CSRD, there's a very specific way that CSRD requires you to run your double materiality assessment, and you use the European Sustainability Reporting Standard, ESRS. For any company outside of the EU that wants to do a best practice, let's call it gold standard double materiality assessment, people are looking for how can we best approach that. We might not follow exactly what the European standards tell us. So that's the reason we're doing this webinar today. Is you might not be following CSRD, but you still want to do a really good double materiality process. How can we utilize the preeminent two standards in the world, GRI and the IFRS standards, to bring them together and their process and their topics and their approach into a really good double materiality assessment? Now, to do that today, we're going to look at two components. We'll talk a little bit with Matt first about GRI, the GRI standards, and then with Jeff about the IFRS. And then we're actually going to bring that together, and we have a really good, overview of that process of how that's been brought together. So we'll kind of, end with that today, and really want to open that up as well to get, thoughts from people in the audience and questions. So without further ado, let's jump into a bit of an overview there. First off then, Matt, I'd love to, get a very brief but high-level introduction on the GRI standards, to set the scene there. Oh, you're on mute, Matt.
All right, there you go. Let's go now. Great to be here with you all today. Thanks for attending. Thanks for having me, Seth, Tim, and Jeff. GRI was founded out of Boston 27 years ago, really to foster more transparency and accountability to corporates and other organizations, to really speak to their impact on the economy, environment, and society. And while that origin story that had the driving force of being investors and environmentalists, GRI has evolved to really cater to the interest of a broad set of stakeholders. And in 2016, the organization fortified the standard setting process, so evolving out of guidance, and then also brought 5 constituency groups into that process. So, and that includes investors, business enterprises, labor organizations, civil society, and mediating institutions. So what that really aims to do is bring in the organizations that disclose, but also those data users that will really be find benefit in learning about the impact that an organization has. And what that evolution also took to getting to standards that evolved to a 2021 update that created a series of standards that have these 3 buckets, if you will. So we have the universal standards, which are applicable to organizations of all types and varieties. We have the sector standards that we're rolling out. We have 4 already published, with more to come. We'll speak a little bit more on that later. And we have our topic standards covering 32 topics that cover environmental, economic, and social impacts. And we'll get into a little bit of the materiality assessment, of course, but that is really covered, or an organization has walked through that process in those universal standards. GRI 1 explains how to use the standards. 2 offers contextual information and other items related to a reporting process. And then 3 is our materiality standard. And it's using GRI 3 in conjunction with sector standards and or topic standards to have an organization speak to how they manage their impacts.
Thanks for that overview. And with that very long history and that kind of really robust standard setting, it's no surprise then that if you look at where GRI stands today with their standards, really GRI has really been leading the way for sustainability reporting globally. And that's really something that year over year, we see all these reports come out from people that look at how are companies reporting on sustainability. Yes, the last few years, we see a bit more compliance coming into the mix. But if we really look at the 4 eminent, reporting standard, generally we do see that is GRI. So what are the latest statistics that you can walk us through on the breadth and scope of GRI reporting on the organizations globally?
Yeah, thanks, Tim. Some of the latest numbers we're seeing, it's over 14,000 organizations, or roughly 14,000 organizations globally using our standards. One of those studies that you referenced, KPMG just came out with one within the last month that looks at the biggest multinationals as well as the top 100 companies in 52 countries, so covering regional presence. So what you can see is that 77% of the multinationals are using GRI. And roughly 70% in a plethora of the different regions. So we see a high level of usage from those larger organizations. GNA Institute also came out with some recent research that has the Russell 1000, 56% of them using the GRI standards. And we see that here in the US as well with the Fortune 500 and S&P 500 above 60%. So it was great to see that first poll is a mix of motivators for why organizations are interested in double materiality. We still see a lot of demand in this more still voluntary context that we're within.
And really good points. And I think out of that research as well, really interesting is under those top 250 largest multinationals, that 50% are already using double materiality. So even before compliance comes in, they're using GRI to look at their impacts, but are also using another standard like the IFRS to look at their financial materiality. So it's really, for a lot of these really kind of larger companies that are doing this work for probably for years already, double materiality is really a given there. Now, with that, Dan, talk us through this a little bit, because it's quite interesting when we talk about compliance. We see that a lot of jurisdictions are looking at the IFRS standards and making that into, from a financial materiality point of view, sustainability compliance. How is GRI feeding globally into policies and into jurisdictions?
Yeah, GRI is pleased to another collaboration that we have with a few academic organizations as well as others that are helping us track ESG and sustainability related policies. And what the latest report of that shows that roughly 500 policies in 92 different countries reference or require the GRI standards. Six of the policies directly require usage of GRI standards. Some of these policies are through stock exchanges. I highly encourage you to check out our website with those partners called Carrots and Sticks. This map shows some of the federal policies, but there's an interactive map there to see what policies are drawing out more disclosures as it relates to sustainability and ESG. And, chief among some of the collaborations that we have on the global stage are, of course, our GRI's role with co-constructing the European Sustainability Reporting Standards, that mechanism to make good on the directives or the mandates out of the CSRD of Europe, which will impact roughly 50,000 organizations across the globe directly, and then many more because of their roles in value chains of organizations that are pulled into that. So really pleased that we've helped build that foundation of reporting that led to those numbers we saw in the previous slide. And many of those organizations already doing this reporting process are on their way to be well prepared for ESRS. And I know Tim and Jeff had a great webinar already on that. So I'll leave the ESRS talk a little bit there.
Yeah, no, thanks for sharing that, Matt. And I think that is a really key thing. And any of the practitioners that are listening today and that have gone through GRI and detail on ESRS will have seen that there's a lot of similarities there. And indeed, ESRS has been heavily influenced and built on GRI. So that's really good to see that those standards and compliance is moving forward. But I think in this world as well, what we see, there's a lot of compliance coming out, but there's still a really critical role there for GRI on that impact side. And that's why the beauty of that double materiality is what we're talking about today. So with that, we spoke about GRI, was really kind of focused on what are the impacts you're having on the world as an organization. Now let's then kind of shift over. This is where I want to bring you in, Jeff, about the IFRS and their sustainability disclosure standards. Can you just kind of give us a quick overview of, how do we get there, and how does the IFRS with their sustainability disclosure standards operate alongside its GRI?
Great. Thanks. Happy to be here. So for those who've been in the sustainability space for a few years, ESG reporting historically was affectionately referred to as a little bit of an alphabet soup, if you will. There were so many different acronyms, so many different reporting standards. Additionally, if we look back to 2015, there was enormous agreement among investors and general users of financial statements that there are many sustainability related risk and opportunities, particularly climate change, the risk from physical and transition impacts here, was on investors' minds, and there was a need to have globally recognized standard for reporting on these risks and opportunities that were deemed to be financially material. We had the Task Force on Climate-Related Financial Disclosures, which was established back in 2015. Their recommendations came out in 2017. Many of the legislation, both in the US at the state level and at jurisdictional levels here with exchanges, have been referencing the Task Force on Climate-Related Financial Disclosures. We also had many other reporting standards. So you had CDSB, you had the International Integrated Reporting Council, IARC, for integrated reporting. You had SASB, the Sustainability Accounting Standards Board here. And at the request of the G20 and the Financial Stability Board, ISSB, the International Sustainability Standards Board, was created, or the formation was announced back in November 2021 at COP26 in Glasgow. Following that, IFRS S1 and S2 was issued in June 2021. And IFRS now brings together many of those organizations under one umbrella here. So you essentially had this amalgamation here, both with TCFD, taking over the responsibility of TCFD, the Transition Plan Task Force Disclosure Framework, the Value Reporting Foundation that combined CDSB and IARC, as well as the SASB standards. So you'll see all of those really reflected in the IFRS Sustainability Disclosure Standards. And now when you take a look at those, they're broken up into IFRS S1, which covers general requirements for disclosure of sustainability related information. And in terms of a topic standard, if you will, they have IFRS S2, which is climate related disclosures. And those have been heavily built and developed based on the TCFD recommendations here. And they are also looking, while the IFRS S1 covers all of the standards there, it doesn't have specific guidance for other topic standards, but they're currently under development. Their research projects are covering biodiversity, ecosystem services, as well as human capital. So we can expect standards for those. Now, when we'll get a little bit later in how they actually look at those risks and opportunities, but let's take a look at how they're being adopted maybe across the world here and referenced.
So that's a really good one, Jeff, here, that we see indeed that, GRI, we saw that map. It's a pretty good kind of global spread there of policy integration. But with IFRS, we see slightly different approach there. So what are jurisdictions doing with IFRS at the moment?
Yeah, so one of the big pivotal milestones was when IOSCO actually approved and supported the IFRS S1 and S2 standards that we had. And there is also the jurisdictional working group. So the jurisdictional working group was comprised of Japan MFS, the US SEC, the UK FCA, EC's FRAG, Chilean FMC. So you had a lot of early buy-in and support for such a standard to be formed. And since that time now, we've also had guidance out to jurisdictions, and there have been upwards of 30 different jurisdictions that have either adopted the IFRS within their standards or put proposals forth to do so, or in the process of doing that. And you can see a pretty even mix here within North America, South America, Asia, Africa, Europe, and these standards are being referenced. So it's a very quick uptake. So you can, as you look to the future, IFRS as well as GRI are really going to be those global baselines that you want to look to for reporting.
Thanks, Jeff, for that introduction into IFRS and their kind of global, adoption now by different jurisdictions. So, as a next step, then really quickly, we've been talking about materiality, but really to kind of bring it back to basics. Materiality, really, what we're trying to do there is trying to really work out in that sustainability realm what are the most significant issues impacting a company and its stakeholders. So that's really kind of the layman's terminology there. But it is worthwhile sometimes to just look a little bit around across those standards that we just looked at. Are there really kind of differences there, and is that really important there? So, Jeff, what are your thoughts on the definition of materiality, and for a regular organization that's looking at doing a materiality assessment, how important is to take one of these official definitions, or how should they think about that?
Great question. So when I work with my clients and we're thinking about how do we want to approach a materiality assessment, we take into consideration a number of factors. We look at their existing enterprise risk management approach to identifying risk and opportunities. We look at any regulatory requirements. So are you publicly listed within the US here? Are you going to have to comply with US SEC? What type of accounting are you doing? Are you doing US GAAP, Canada GAAP? Are you using IFRS accounting standards there? And what is material information? And those things are going to be really important for determining how you should approach a DMA, because where you want to make sure that there's alignment between your sustainability reporting and also your financial accounting reporting there, and at least understand the differences. So if you are disclosing, say, just GRI, not IFRS, you make clear statements about what you mean when you say these are material topics or this is material information. So what we've seen is there's trying to then interoperability between these standards. So the IFRS accounting standard, which is on the left here, as you'll see with the IFRS sustainability, it's almost exactly the same definition. They're fully aligned, with the exception that they're highlighting sustainability related financial disclosures. And then what you'll see with governments that are trying to align with these is the Australian government. They've recently adopted, or in the process with their standards, and their definition has completely adopted the IFRS sustainability. So there's full alignment between the accounting, the IFRS sustainability, and the national reporting standards there. The US SEC is a little different. I'm not going to go into the definition itself, but you can see. And then GRI as well, from an impact perspective, is also different, but I'm sure Matt can speak to in greater detail here later.
So I think that's a real key there, that it's really important to look at what are you already doing, and in your business, what are you doing from an accounting perspective. But we're trying now throughout the world, we see across our standards, there's a lot of alignment between, we look at materiality. The key thing is to think about, like what we already flagged a little bit, is that impact materiality and financial materiality. So I think that's a real next component to look at. If we are going to use GRI and IFRS, why are we using both of them? Well, there's a good reason for that, because they're both looking at a different perspective effectively. So what we spoke about first with GRI is really focused on the impact your organization or company has on the world at large. What is the impact you're having on people, planet, society, the environment? So it's really that outward looking perspective. And it's about assessing those impacts and working out which of those impacts, positive and negative, are material. And that is what you then want to disclose on. So that's really one perspective that's really important. So that's why we're talking about looking at GRI. And the other side that Jeff just kind of highlighted is the opposite side, and that is really looking at that financial materiality. And then we're talking about which sustainability-related risks and opportunities might impact your company's financial performance. So we're looking at that outside-in perspective. We're looking at the outside world around sustainability. So we look at climate, for instance, physical impacts of climate change. How might that pose a risk or potentially an opportunity to your business? So we're looking at two different concepts there. And across those concepts, we're looking at three things really. We're looking at the impacts, the risks, and the opportunities. And of course, with the impacts, we're looking at both positive and negative impact. So that's what we're trying to do. And that's why those two standards, GRI and IFRS, are so useful, because they're coming from different perspectives. And if we bring that together, that's what we call double materiality. So that's really what we're trying to do with this approach. Now, just to look at those two perspectives in a little bit more detail, let's start with GRI. And Matt, that process to kind of start to understand what your impacts are. Like we have the GRI process here for impact materiality at a very high level. Can you like talk us through, how do you work your way through that to ultimately get to that right-hand side where it says material topics? What's the process that GRI gets you to go through to determine those material topics and impacts that you're having?
Sure. Thanks, Tim. Yeah, an organization reporting in accordance with the GRI standards is required to determine its material topics. But yes, in GRI's lens, that means the most significant impacts on the economy, environment, and society. So sometimes, particularly in this jurisdiction in the US, right, we have to be careful with that materiality term. And what you'll see in sustainability reports is a preface citing that when materiality is used, it means in this GRI context, or an organization might avoid that term because of those pitfalls. But that's why I actually really like this language around impact, risk, and opportunities. I think that's helpful for a global dialogue as when we talk about double materiality. But there are 4 steps for an organization to really go through that materiality assessment and reporting process that GRI outlines. The first 3 steps in the process are determine the material topics related to the organization's ongoing identification and assessment of impacts. So during these steps, the organization identifies and assesses its impacts regularly as part of their day-to-day activities, and while engaging with relevant stakeholders and experts. So these are ongoing. This is kind of maybe a misnomer to some that a sustainability reporting process is kind of once a year. But GRI really highlights that this is an ongoing thing, and it's both because that's important to your impacts, but we see a lot of buy-in by organizations because they find this tremendously important for them because of that engagement with their stakeholders and understanding the impacts that they have, because over time, whether that's the short, medium, or long term, that can bleed into those financial risks and opportunities. And that's why there is that complementary nature. So, this first step is understand the organization's context. The organization should create that high-level overview of its activities and business relationships, the sustainability context in which it operates within, and the overview of its stakeholders. And this provides the organization with the critical information for identifying its actual and potential impacts. And as Tim cited, positive and negative. Then identify actual and potential impacts, looking at the likelihood of possible impacts and severity. This is where topics are considered in the sector standards too, that we've recently rolled out in the last couple of years, is to bring more consistency and comparability to sectors, but also aid in that materiality assessment process, line up likely material topics for an organization in that sector. It's over this step 2 and 3, engage with relevant stakeholders and experts, engage with them to understand the impacts that you have on stakeholders and also what issues are of interest to them. And then we finally get to the 4th stage, where you're prioritizing the most significant impacts for reporting. So of course, any entity does not have unlimited resources. You need to really zero in on the most significant impacts that you can have, and create a proper process to identify these impacts and explain that out in your GRI reporting. Right? When it comes down to it, the GRI standards are about transparency and accountability. So some of this is really articulating that process of where you get to your conclusions of what are your most significant impacts, how do you manage those impacts, and then disclosing that process for your report.
Thanks, Matt, for that overview. And I think that final bit, I think, is really important, that a lot of companies that are new to this work don't realize that it's not just getting as quick as possible to that list on the right-hand side with material topics. It is about the process. The process is really important there. And yes, you do want to get to the end so you know what those material topics are, but it's equally as important to engage with those stakeholders and to really document that process of how have you gone through this. Now, you just flagged we looked at this a little bit earlier, the sector standards. And I think this is a really good one that goes to, I just saw a question coming from Magda who asked about, what's the role of benchmarking? Like, that you don't start from scratch in terms of topics. Like, how do you know what to consider when you're thinking about impacts? What are the relevant topical areas to think about? Do we have any impacts? And I think that's where those sector standards come in. Can you say a little bit about that? What that role of those sector standards can be to help organizations?
Yeah, GRI found in our independent global standard setting body, the GSSB, really identified that while the GRI standards has been used by thousands of organizations around the globe, there was still some challenges, and this is why we were also seeing voluntary move to regulatory compliance. There's some challenges with comparability and consistency with the organization's reporting. And part of that was some of these sectors that were higher reporting sectors were still going through a materiality assessment process that led them to identify different material topics. And so one mechanism that the GSSB put forward to kind of help data users and stakeholders make informed decisions and do their own benchmarking of these organizations is through cultivation of more consistency and comparability of listing out the likely material topics for a sector. Also identifying, is there a gap in the generic topic standards, which are applicable to all organizations that find that to be a material topic. But if there was a gap, we wanted to address it in the sector standard. So for instance, in the agriculture, aquaculture, and fishing sector standard, soil health was not yet represented. That was an added disclosure. But otherwise, if a gap's not existing, that's not covering a particular component to a sector, these sector standards will point to likely material topics within the 32 topic standards. So it's not reinventing the wheel for the system of the GRI standards, but this helps make it a modular approach, bring about more consistency and comparability to a sector, help them in their materiality assessment, and point to those known topic standards that have already been used. And as they get updated, which we're doing right now with our climate and energy revision, after we just updated our biodiversity revision earlier this year, and moving forward to some other social components in some social related topic standards. So that's where these three systems come into play, or the three series come into play, I should say, and help organizations with their materiality assessment process through that GRI lens.
Excellent. Thanks for that, Matt. And I hope that answers your question, Magda. So yes, there are, from a GRI perspective, definitely look at those sector standards. You're not starting, with a blank page there. Find your industry there. There are more industries coming, and look at peers as well, what they've done. Now, that's the GRI kind of approach, impact materiality. Let's jump over to IFRS. And Jeff, I'll just like to just kind of hand over to you here. Can you just walk us through at a high level how IFRS looks at that process?
Definitely, thanks. And we have a really detailed slide coming up, so I'll dive into the process much deeper then. But at a high level here, IFRS sustainability standards really require just essentially 4 major steps here. One is going to be to build on existing management approaches to identifying your risk and opportunities. So look at your enterprise risk management methodology, financial thresholds for those risk and opportunities. Use sources of guidance set out in IFRS 1 and S2. So they will require that you at least refer to or consider the SASB standards, which are part of IFRS, and for any existing standards where you've identified financially material impacts, risk and opportunities, being at the moment now IFRS S2, which is for climate change, and they will be coming out with other standards as well. They also encourage you to look at other sources of guidance, so that being the GRI standards here and those sector guidance that they have, CDSB guidance for topics, as well as the ESRS, the European Sustainability Reporting Standards. They also require you to identify your risk and opportunities using all reasonable and supportable information that is available to the entity at the reporting date without undue cost and effort. It's been a lot of debates around how much effort, how much cost should you put in this, so they use the term undue. This should be across the value chain as well, and you should reassess the scope of the sustainability reporting related risk and opportunities throughout your value chain if there is a significant event that has occurred, new regulation that's come out, or there's been a change of circumstances or your business model or products there. So they do require you to do that reevaluation. The last point is, and I'll get into this more detail later, is that in order to determine if there are sustainability related risk and opportunities that are financially material, you have to first map your value chain and understand and map your dependencies across your value chain and map those impacts as well. Because often it's sustainability related risk and opportunities that are financially material give rise from those impacts and those dependencies. It's not always the case, but it is. And so if you haven't done that due diligence up front, you won't be able to actually identify truly and holistically what those are. The big difference between GRI and IFRS here is that it's on the disclosure side. So GRI is looking for the disclosure of material impacts. IFRS is looking for the disclosure of financially material risk and opportunities, which often come from those dependencies and impacts on the ground.
I think that is if you take away anything from this webinar, that's a really important thing. I think that we see that in CSRD where they say start with impacts, because impacts often drive a lot of risk and opportunity. And we now see that really kind of come out from IFRS as well, that they say, yeah, ultimately we want to understand your financially material risks and opportunities, but to get there, you have to get into those critical dependencies and to those impacts. So that's a real key takeaway there. Now we spoke about the GRI sector standards, but on the IFRS, there's another way. Jeff, can you tell us a little bit about the SASB industry standards and how we should be using those?
Yes. So many individuals are probably familiar, especially in North America, with like the NICE classification system, the North America Industry Classification System. SASB, when they started trying to find commonalities and ways to classify companies and group them around where their focus, sustainability, risk, and opportunities, they realized that the NICE and other standards were not really fit for purpose. So they came out with their own classification system called SICS, S-I-C-S. So it's the Sustainable Industry Classification System. And that is where they have actually grouped companies in a sector industry focus where they have similar dependencies and similar sustainability related risk and opportunities there. And so if you go to their website, you can actually look up your sector, and those sector standards will have common metrics and topics for your industry. And companies may actually be, particularly conglomerates, have multiple sectors in which they would operate in, or which the SASB standards would apply. But they do have 11 sectors, 77 industries here. And you can have a wide range of disclosure topics, I think upwards of 444, I think is the exact number, and also 981 accounting metrics. So it's a really useful standard to go ahead and see what might, a starting point for what might be your material topics and metrics from an industry perspective.
Excellent. So we have the SASB industry standards, GRI sector standards are both great starting points to look at, but ultimately also to come back to in terms of your disclosure. Now, with all that, we've kind of like taken two parallel paths now on the GRI and on the IFRS side of things. So let's see if we can bring that together. Jeff, you've made a really great effort in trying to visualize that. This is that process of trying to do that double materiality assessment using GRI and IFRS, the process. Can you talk us through that?
Yeah, definitely. It's been challenging. And, I've been looking across the internet and there to find where there is a process that has combined both of these, that where you could report and conduct a DMA in accordance with these standards. And it just wasn't available. And my clients were demanding, hey, how can we do this, right? Because you don't want to do one process for one reporting standard and another process for another. How can we address multiple requirements in the same process to save money, save cost? And so I've developed this under Azuri and been utilizing it with my clients who are conducting DMA and through Social Suite software here. So it's been really interesting. So this is going to be to meet requirements, but then you can go in more depth if you want to. We start on the left. It's kind of understanding the context. So what do we mean by understanding the context? Both IFR standards and GRI speak to this phase in the DMA process that you'll have there. And it's like, what is your business model? What activities do you have? What products do you have? In what geographies are you operating in? What is your business strategy? How have you integrated sustainability into that business strategy? What sustainability targets have you set here? looking at your ERM, what enterprise risk management methodology you have, where are your thresholds, what are your existing governance structures, and also, really importantly, what are your business relationships, both from downstream on the customer side here, upstream on the supplier side, and working your way down the value chain through tier 3, tier 4 suppliers, and also end users. So you really want to look at that. Where are we now, and what context are we setting? And then also you want to move into, well, what are our reporting requirements here that our stakeholders are seeking? We've been regulatory here, voluntary, investor-led. And so you want to move into those reference sources of guidance. So the standards actually require certain sources of guidance to be used here. So when we're looking at IFRS, we talked about that. You have IFRS S1 and S2. They do require that you at least consider and refer to the SASB standards, and then it's optional to refer to others. GRI requires GRI 101 through 103. You have the sectors and the topics that are in there. Obviously, you can omit that, but you have a justification for it. Then they also encourage you to consider other standards there in your process, be it CDSB, ESRS, Task Force on Nature-Related Financial Disclosures, and then also looking at industry practices or regional practices where they've identified common risk, opportunities, impacts. The next stage is to look to really map out your value chain in detail here and start that stakeholder engagement process on that to say, what are our dependencies? Our dependencies on the different types of capital, be them human capital, natural capital, social capital that we have here. And then to do that across the entire value chain, as I mentioned, so downstream, upstream, and the operations. That then leads us to attempting to identify what our actual and also our potential impacts are on people, including individuals' human rights, the economy, and the environment. This is a big part of your GRI that you're looking for, that's clearly expressed there. And we usually do that through a stakeholder engagement process to understand that as part of your due diligence, but then also conducting various risk assessments here and looking to existing published information that we might have and other research methods. We then need to move to assess the significance of those impacts. So for those who are familiar with CSRD or GRI, they look at both positive and negative impacts, and there's different general equations for how we would approach that. Our equations get a lot more in-depth and customized, but you can think of what is the scale, what is the scope, and what is the likelihood of a positive impact. And then for negative impacts, we want to look at the severity of that as well. And the severity is going to be your scale, your scope, and your irremediable character of impact. So when we talk about irremediable character of impact, that's meaning if we were having a negative impact and we wanted to remediate that impact, whether it's being on human rights or it's on the environment, how difficult would it be to remediate it? And that together, plus the likelihood of that negative impact occurring, helps us to define whether that's a material impact or not here. So we've mapped the value chain, we've engaged stakeholders, we've identified our dependencies, we've identified our actual and potential impacts, and we've started to look at measuring the significance of those. We then want to look at the interdependencies between the relationships that we have, those dependencies, and our impacts. So how they're tied to the entity. And I find this missing a lot in the DMAs that I conduct. There's also going to be interdependencies between the different impacts and the risk and the opportunities there. And this really comes around to moving towards looking at the world from a systems perspective and trying to define those and see what those root causes are. That's where the discussions can be quite tight. From there, then we are able to shift and say, okay, so we know what these impacts are, we know what these dependencies are, we've mapped the materiality of them. What are going to be the ones that are financially material to us, so that are going to impact us? And this is where we look to our existing business management approaches to measuring risk and opportunities. Do we have set financial thresholds? Have those opportunities or have those risks, are they likely to exceed those set thresholds that are there over what time periods here? And those we're going to be looking at, what are the transmission channels? So is it impacting cash flow? Is it impacting access to finance? Is it impacting the cost of capital here? And then once we have those together, we then need to prioritize the most significant risk and opportunities by topic, and then also by stakeholder. And then a best practice for that is then to, once you've gotten to that point, to validate those findings with some of the most important stakeholders. So go back, say, did we get this right? Are we missing anything? Is our calculation off on that? And that's usually the holistic scope. The last thing I'd like to add into this, though, is just there is opportunity for assurance. So it's important to, one, try to get your engaged early in the process and kind of understand and work through that your DMA process and what you're planning to do, so that everyone is on board.
That's quite something, Jeff. I really appreciate this, you running us through that. And I see there's a comment coming from Gaurav, who says that indeed the value chain is such a crucial component here, that if you don't fully understand your value chain, you're going to miss out on so much. So I think, like, what I would highlight indeed is the value chain mapping is really important to do that and do that well. The other part you flag that a lot of companies kind of miss at the moment is often that interaction there at the bottom left with the impacts and the dependencies. And the key thing, and I think, Matt, that's something that really strongly comes out of GRI as well. Like, clearly, you've mentioned it quite a few times, Jeff, the engagement of stakeholders in here. It's such a crucial part. We see that in Europe as well, on the CSRD and ESRS, that is a requirement there. Still, a lot of companies struggle with that, or like really wonder how to do that. Why, Matt, why is it so important to get those stakeholder views or engage them in that process? We hear a lot of businesses that say, "Oh, we know everything. We have a whole team. We know. Why do we need to talk to other people?"
Yeah, well, when we're thinking about stakeholders, it's internal, external experts or groups that are impacted by the organization. And what we see in the evolution of reporting too, once an organization gets on this track of reporting and focusing on their impacts, you see that it doesn't scale back the numbers of reporting on impacts. And so you can see that the organization is generating value. And much of that is that engagement with their value chain. I mean, our standards very specifically cite, and so too do ESRS, that your biggest impacts, that often is, and therefore an organization needs to be accountable for their impacts in their supply chain. And even the revision to the biodiversity standard that we just pushed out, it is guiding an organization to not report on all their biodiversity and nature impacts, right? That's unfortunately not all organizations have the resources to do so. But you do need to find a process to identify your biggest impacts, which often lie in a supply chain. So really highlighting that in that revision to our biodiversity standard. I'll also double click, if you will, or double down on a component you both have spoken to, is this complementary nature between financial materiality and impact materiality, or impact, risks, and opportunities. And this is also why we do have a critical collaboration agreement with IFRS directly to work to create a seamless system that involves reporting to impacts, risks, and opportunities that meet the needs of capital markets and investors, but also this wider set of stakeholders. And what an exciting first iteration of that is working together on this biodiversity standard, which we rolled out earlier this year. And IFRS is looking at that for its BEES project. So biodiversity, ecosystem, and ecosystem services. And this is much because those impacts over time, whether that's short, medium, or long term, become those risks and opportunities. And we want to make sure that those disclosures sync up. The reporting is certainly done to better performance and better understanding by an organization, by its stakeholders. And so we need to make that process as seamless as possible, no more arduous than it needs to be, so the better performance, which we're all after on the environmental, social, and economic front, can happen.
And I think that is the key there, that collaboration that is already happening now between GRI and IFRS, that really coming together. And I think, Jeff, you already captured that on this slide. This is where the world's moving towards. We all understand that double materiality is not really what we should be looking at and doing. It's more the doing part where we're all trying to now find our way and how do we do that efficiently. So with that, I think that's a great note, Matt, to kind of end the webinar on. And I want to encourage people, I'll ask Seth to come back and see if there's any further questions that have come in, but really encourage people to, again, look at this slide and think, are there any further questions you have for us today? Because there's a lot to go through, and there's a potential lot of questions there, and we're happy to answer them. Over to you, Seth.
Yeah, that was a great webinar, very informative. So thanks, everybody. I did get a few questions directly that came in. The first one's for Matt. The question is, how often do you need to update or review a GRI-specific materiality assessment?
Great question. So we do see an evolution of norms here. I feel like a good portion of organizations made it a process that would take place every couple of years because they're seeing the value in this reporting process, because organizations are trying to be prepared for elevated stakeholder expectations and demand, as well as the evolving regulatory landscape. And you're much better off as an organization getting started now and in a voluntary context than when you're hit with regulations. That we're seeing this increase to an annual assessment often. But just like that infograph that is pulled directly out of our standards, so you can always go to the GRI standards directly, and GRI 1 really articulates how to use the standards. And that infograph was from GRI 3, the materiality assessment one. But those first three steps are kind of an ongoing process. So maybe the formal DMA and double materiality assessment, you do. We're going to see organizations really evolve to make it some kind of an annual process. Maybe there's a deeper dive 1 year and then a year off, and then they come back and reassess. But it really is an ongoing activity.
I really like that, and we see that happening now with a lot of the larger companies. They say that it does not make sense to take a month, a year, and do a sprint to identify our impact, risks, and opportunities, and then not worry about it for 11 months. It is an ongoing process. So that management and uncovering and keeping track of your impacts, risks, and opportunities should be ongoing for companies. But then you might take that, snapshot of where you are to inform your strategy setting or your reporting or compliance requirements. But the process of identifying and managing those topics are ongoing. So I think that a lot of companies are seeing this as the business as usual, the new normal for how to deal with materiality.
Yeah. Thank you. All right. So the next question that came in, it's, if I run a double materiality assessment, will this also cover regulations that require a single financial IFRS related assessment, such as what's potentially upcoming in markets like in Canada, the UK, and or Australia?
Yeah, I don't want to give any kind of, financial reporting advice on this here, but typically if you were to conduct a double materiality assessment, and as part of that process, you followed IFRS's methodology that they have here, and then as well as followed your respective jurisdictions methodology for that, because you have to first confirm. There have been some adjustments and some additional requirements within jurisdictions on top of the general IFRS, particularly around assurance, for example, whether it's limited or reasonable. It could, and so that's the key, and that's why we tried to create this process. And if you go back to that first box on the process there, it's understanding the context. So and understanding those definitions. We had a slide on the different definitions, and then making sure your definition of materiality and the regulatory compliance requirements will be met through that process. And so often you'll see it that companies are subject to multiple jurisdictions and reporting there. And so you want to, this is kind of a value add consulting, is to come in and take those different definitions of materiality as well as your voluntary ambition for reporting and align the different standards and come up with a unique process that's fit for purpose for your organization. And what you'll see is that will often change year over year with new regulation that's coming in, with new markets that you may enter. So for that reason, you need to continuously look at that. And that's kind of the dynamic materiality essentially here. Is some issues one year might not be material, but next year, because of regulatory changes or increased impacts from climate change or biodiversity loss, these issues may then become financially material.
Great. Thanks, Jeff. and a really smart comment by Isabel in the audience here. A DMA or any materiality assessment needs to be dynamic and ongoing in nature, and also should be reviewed by a working group. So really good point there. All right, last question that I have that came in. The question is, how can a software solution such as potentially Social Suite help in the materiality process? And maybe I'll kick this over to Jeff to answer.
So for individuals who have been attempting, let's say CSRD, Corporate Standard Reporting Directive, a DMA, or actually trying to do a DMA with IFRS and GRI, there's the stakeholder engagement process and the mapping of the value chain incurs an enormous amount of information. And then you need to link up to thousands of data points on the metrics and hundreds of potential impacts, risk, and opportunities. And each one of those needs to be tied to topics and stakeholders. So you just have a mismatch of interconnections. And that needs to then feed in to your scoring. So trying to accomplish that in Excel is incredibly cumbersome and difficult and requires Excel programming capabilities there. Additionally, the first time you undertake a DMA, whether you use technology or you don't use technology, the biggest time constraints are that value chain mapping and that stakeholder engagement process and the learning that you're going to achieve throughout your organization and with your stakeholders. And you want to capture that. And so, and be able to conduct something similar and update and look back at what you did. When you do it in Excel, it's hard to capture information. You can't upload files. You've got links. You've got 20 different documents. And so when you use software, the second year, the third year, when you do that, everything is stored. All of your assessments are stored, your stakeholder engagement, your surveys are there. So it's easy to have a much more cost-effective update process next year. You can make minor adjustments to business units or stakeholders that you engage, or you could readjust your scoring here once you have more information. The other big part is savings on assurance. So I've seen quotes for over $1 million for just assurance readiness of sustainability for CSRD coming through, which uses a DMA. They're having to review so many different documents out there. Things can get lost. It's hard to understand where the decisions were made because the process as well as the outcome needs to be assured. So when you have a software, all of those documents can be in one place and you can have a timestamp on when those decisions were made. And so it's an auditable process, and that greatly reduces both the readiness assurance cost as well as the assurance in the future.
Yeah, great answer. Thanks, Jeff. And let's tie the knot here. So again, thanks everybody for attending today's webinar. Matt, really appreciate you coming on here, and Jeff. For those in the audience, if you want to connect with Matt or Jeff, feel free to shoot them a note on LinkedIn or connect with them on LinkedIn. Jeff's contact information is right here in this slide as well. For anyone else who's interested in learning more about Social Suite and how we could help improve your materiality process, feel free to reach out to me directly. My email address is right here, or if you have additional questions for Tim. Otherwise, we have our newsletter up on our website. You could subscribe to our newsletter, and we hope to see you on future webinars. So thanks so much, everybody, for joining, and have a happy holidays.
Thanks for having us.
Thanks all.